And joining me on the podcast right now, and of course, you can catch us in video in full Technicolor, and you can see our expressions of surprise and happiness and joy or sadness as where we are in the markets right now. Paul Hill's here. You're at Paul.
Yeah, morning, Justin, and a big apologies for not inviting you to this podcast earlier on. So
yeah,
I took my hat to you to be able to turn it round so quickly.
No, I know. Well, you know what? I thought maybe he's gone on holidays. I don't blame you because at the moment, that's selling May. If I was compounding the issues we've had with the market being down for now, what 658 days AMAS from the high, and we've now got that sell in May, go away. And I thought you were doing that. I thought not a bad timing if you've done that, because I was looking, AIM has hit new lows. You know, the October lows. We were saying, will it revisit that? And I said a while back, I got a feeling a bit bearish. That's why I'm a bit of cash, and it has hit those lows again. And in fact, it's it literally on Tuesday this week. The previous low was Monday. The previous low before that was Friday. Before that was October. So we had now 4 or 5 days below that, and it's been trading down for 7 days in a row. Doesn't do that very often. AIM all share index I'm talking about. Not only that, the relative strength index was below 14. It's only done that 5 times in the last 10 years. But that, in my mind, it's contrarily quite bullish, because it does bounce when that happens. It may be a sort of short-term bounce, but it does bounce. It's almost like, I think people, investing is about probability, really. A lot of it, you're betting on the future earnings and revenues of companies, pretty much. And with AIM like that, when it sort of bounces, it's like waiting for the ace of spades to come out of a deck of cards. So sooner or later, if it hasn't come out in the first 5, 10 hands, the more you go through those hands, the more chance the ace is going to come out, and it's the more chance of a rally, because very rarely does it go down 8 days in a row. And I think FTSE 250 did 10 days in a row recently. So there's a lot of, the markets are very, very bearish, aren't they?
Oh yeah, I mean, I was actually looking at the top level numbers, and although Nasdaq's up about 25% this year, AIM is down. Well, it certainly was of Monday, and it's probably further now. It was 8% year to date down, and as you rightly say, from its all-time highs, or from it was sort of like 18 months ago, it was it's about 45% down. And when you're through sort of like that lens, I mean, my portfolio has been suffering in June as well, so everybody's been sort of like seeing red, unfortunately. But I do love that glass is half full sort of optimistic view, because I'm with you. I mean, as long as you've chosen reasonably wisely that the companies that you invest in don't need to do emergency fundraisers, you can get through the sort of like the wobbly bits and the sort of like the ups and downs of the market, then next year, looking through the lens, if we do start seeing sort of like wage inflation coming down, I'm optimistic that the central banks will start reducing interest rates once they get that grip on sort of like sustainable sort of 2 to 3% CPI. And on that event, if you do bring the cost of capital down, that will benefit the small caps significantly. And I know I've been banging the table or talking about this and got my timing totally wrong, but as I say, I think small caps are likely to come out of it faster than the large caps if we start seeing interest rates come down, because that's really the big Achilles heel for most of AIM stocks. Because if you have a raise, or just when you come to discount the future cash flows when it comes to valuation, but if you give those a bit of sort of like help, then we could see a bit of a rally. But I'm with you. I mean, I think you've just got to really it's hunker down, isn't it, really? Select wisely, select cautiously. don't expect to be a rich man soon.
No, exactly. Well, it's like that. I talked a couple of times about this recently, just on podcasts. And if you look at, say, probabilities, the average bear market's pretty much around about 19 to 22 months, depending if you have a recession or not. Now, we are 16 months in from the start of the bear market on AIM, pretty much. So we're nearing the end game here. And I've looked back at the inversion of the yield curves and when recession kicks in, and literally everything from sort of the shortest one was the COVID one, where it's really odd, isn't it? The inversion of the yield curve happened just before the COVID pandemic. There was no way you could predict that. I mean, it must have been a fluke, but it did it, and we had a technical recession. But it's normally about it can be up to sort of 2 years as a recession. But the good thing is, recessions tend to see the bottom of the market. So it's almost like a lot of times the data is backward facing, like, you know, that we all know. So there's been some revisions of GDP figures before where we said, oh, we are in recession, by the way, or we were in recession for the last 3 months. But the market's known this for what? 18 months pretty much, because it's been going down for 18 months. Well, the AIM and FTSE 250 has, FTSE 100 has held quite well. But as I say, the market does know this. It's sort of priced a lot of it in already. So you may see, you know, bumping around here, finding a little lower low, but I don't think it'll go down as much as it has gone down. And
I
right
hope
now,
not.
no.
I don't want it to go down to the 45%, that's for sure.
No, we may as well just pack up. Yeah, AIM's down like 43%. It's like,
yeah, from its all time. I knew it was a big number. Yeah, that's sort of like crazy figure. But
I mean, AIM 100 is on 45%. But I mean, you know, we are around about that level now, and there are some. I'm seeing because it's funny. You have a mentality different when you have a bit of cash. You know, I'm looking at stocks and seeing them go down. and think I don't mind if it goes on further because there's something going wrong here. There's going to be a big technical bounce when it does bounce. And maybe if you're getting at the sort of right level, you'll do very, very well. And it's lots of stocks. You do very, very. In fact, look in America, of course, house builders or home builders, as they call them. It's good Americans say home builders because we're building your future home. It's not a house, it's your home. I love the way they personalize everything and sell everything, Americans, but they've done very well just because the Fed paused. That's going to happen over here. You know, once the Bank of England pauses, and the trajectory is the direction of travel of interest rate stops pretty much. I think house builders could do very well because it just stabilizes the market a bit. And so, you know, I'm looking at house builders.
I mean, it's actually the US house builders haven't performed well because of the Fed rate expectations. I mean, if anything, they've continued to go up as they have in the UK. The reason why US home builders have done well is because typically their housing market, the mortgage owners have 30 to 25, 30-year mortgages. And because they've refinanced or bought those houses at really super low rates over the last 3 or 4 years, etc., in fact, over the last 10 years, then they're not moving. So existing home sales are very low, which means that you've still got relatively strong demand. And it means that you've got effectively the home builders selling into a false market because there aren't that many sellers of existing homes, and therefore they can continue with price rises. You don't get that in the UK because we have 2-year and 3-year, 5-year fix, and they're rolling over. But
I think that if you saw the chaos the mini budget caused, in fact, we got bond yields higher than that, but that caused instability in the market, you know, and house builders said that, and this instability has come back, even though interest rates are higher, stability is going. So I think the stability will help house builders a little bit. I think we will have a bit of updates coming through saying, I'm just looking on the portals, you see a lot of houses coming down in price. So this is one house I'm looking at. It's come down about 3 or 4 times in the last 3 or 4 weeks. It's a really nice house. And
wow. Buckingham Palace, is it? Because I know Charlie's leaving, isn't he?
Yeah, I know. I got up at Will's, Prince William's one of these doing this job for the homelessness. And thinking, hang on, Buckingham Palace is empty. Yeah, you can put loads of people up in that, you know. But I think keep an eye on house builders. For a long time, I went into Gleeson for a while. I came back out because it's rolling over, and it did sort of roll over. But Gleeson and Taylor Wimpey, some of that, I think, you know, it's almost to keep a little bit of money aside for companies like that. That are good companies, and they will be good companies again. It's just the market at the moment is a bit turbulent, and people are not going to want to take on mortgages or buy new houses at the moment because they're thinking, where's this going? Interest rates are really high. So I mean,
no, I'm with you. I mean,
opportunities out there, aren't there? Plenty.
Oh, yeah. No, I mean, my play in that sort of area is that premium brick manufacturer, Michelmersh. And as I mentioned, I spoke to the CEO Frank Anna just recently. And I think, it's absolutely on track. And it's been quite interesting how stable that share price has been, even though the wider housing market has come off over the last 3 weeks by 20%. Now, yes, some of it has been, sort of like share buybacks, but actually the shares have increased. So I bought about 2 months ago, and I've got a nice, good sort of like, dividend off the, paid to me. The shares have gone up slightly, so I'm surprised how solid that one has been. And the other one I own, which is a sort of related sector, is it's in build tech. It's Eleco, which does sort of like project management for a lot of infrastructure and these huge, great big sort of office buildings and property buildings and stuff like that. Big positions out in Europe and in Germany and the UK, and hoping to get out into anyway. They made a nice little tuck-in acquisition actually just this last week of a similar sort of business, Best Outcome it's called, only for about sort of £4 million, but 2 times sales. And it's complementary, because what they're going to do is multiple. That their software allows you to do multiple large projects, but not just in the build tech sector, but in all kinds of projects. It can be digitization. And they've got a big footprint in the NHS, which desperately needs sort of like, digitization. So there's a sales synergies there, and then there's obviously the cost synergies of hosting, because you don't need 2 sets of hosting agreements with Amazon Web Services and all that kind of stuff. So they'll and it will help. Hopefully, it'll take them into new regions. So a bit of cross things. So it's a nice little acquisition there. I mean, my fair value on the stock is 130p, and I think it's trading at just less than 80 now. So I think there's plenty of opportunity there. I did speak to the CEO, Jonathan Hunter, earlier in the week, and he's delighted with the acquisition. But clearly it's a tough sector. We know property, we know offices, we know commercial real estate, housing is not going gangbuster at the moment. And although most of their revenues, 70%, is recurring and high margin, good gross margins, it doesn't mean they're going to be immune. The good thing is they've got a rock solid balance sheet, sort of 10 million or so of cash, and they can get through just about anything. So that's not a stupid play actually, because that's how they're trading at good valuations.
Yeah, but you said with Michelmersh and that, I mean, companies like this, are high chance of recovering back to where they were previously. They're paying a dividend. As long as you don't overexpose, and you just sit there tight and just collect a dividend for a while, and then maybe when it starts to move, the market start to improve, then start going more. But yeah, I mean, I saw your interview. In fact, I looked up. Was it a guy? He talked about Future. Was it Will Thorne or something like that? Or
James Thorne of Columbia Threadneedle.
Yeah.
Future Group.
Yeah. And I completely agree with him. In fact, we said this before. I mean, we talked about AI, and you've got this compounding worry about the advertising markets, which Future is in, always get hit during a downturn first and foremost. And then you've got the compounding worry of AI taking over the business or part of the business. And I sort of agree with him. It's not. It's going to be more, application specific AI, I think. And companies, in fact, Future, the CEO, watched the presentation, was already showing. He demonstrated AI on the site. So basically, you ask for articles or computers of a certain price range, and it would answer for you and come up with articles. And I think that's the way it will be going forward. Right now, if you do a Google search, they'll give a summary right at the top, of Google search before you click any links. But there'll be a link with that as well. There'll be more of that. I think the best, content or whatever you're looking to source, they'll still show source links. And I think, and it's the companies using AI as well, they will sort of, connect with each other, talk with each other. So I think that's what I think. Future, for example, is way oversold now.
It's 5 times PE.
Yeah, well, I think
I was looking at it with James, and I was thinking, really, is it that low?
Yeah, they're like 40 quid a share, and now they're down to what, 6 quid, something like that.
I know. Do you still own them, or did you decide to bail?
No, again, they rolled over. I'm in this market, I'm wary of companies just rolling over. I thought it was going to go in the right direction. Fundamentally, I thought it was fine, strong, and that was at like £8, £9 a share, I think it was. And I started rolling over. Okay, it broke a sort of support level. It shouldn't have gone below. And I just thought, okay, I'm going to cut my loss there and leave it, because I will want to get back in there. But I mean, it's just, if I hadn't done that, I'd be another 50% down on that. So I mean,
join the club.
I know. So I mean, it's funny. I often have this snobbery about being a long-term investor, and I think I've got to leave that alone, because if I invest in a company, or research a company that does well, I will be a long-term investor as long as it keeps doing well. Now, if it starts going against me and going wrong, I'm not going to say, no, I'm a long-term investor, I'm going to lose money. But it's like, no, I'm not about that. If it goes against me, goes wrong, then I'm going to get out and maybe look at it again to get, okay, where did that go wrong? So I'm an investor. If the investment plays out, I am long term. If it goes against me, I'm not going to be there for a long time. So
I think the difference is long term is based on fundamentals. It's not based on price. That's the key. And if
fundamentals is largely forecasting as well. Now that is a little bit. I mean, okay, you can have companies with greater visibility and all that, but a lot of that is guesswork. It's like some of that. The longer you go out, like look at Future, the fundamentals are good. Gleason's good. I mean, Taylor Wimpey's good, but it doesn't stop you taking a massive hit in the stock. So you've also got to look at. I think that's why I like to marry technicals a little bit with fundamentals, because the momentum go against you. Think, okay, it's not right at the moment. Sometimes even when the fundamentals seem spot on and the technicals go against you, and you think, hang on, and then you get some news coming out. Oh, you get a worse trading update than you thought, and you think, okay, well that explains that then. So sometimes the market, the buying and selling, actual volume going through the stock is where it's at. You think, what's going on there? And
you'll hate the next stock I've just bought over the last few days. Then it's on AIM. It's got terrible it's got terrible technicals, but in my view, very good fundamentals, and is really another stealth play on sort of like cyber security and AI. And it's called GB Group, which is basically about 500.
Oh yeah, do you know what? I did actually. Yeah, when they had their results a while back, I remember you commented that. I put them through my spreadsheet. So that's awful. It scores really lowly. So what happens there, though? So
I mean, but basically, what do they do? I mean, they are one of the leaders, one of the top 4, I think, in terms of sort of like world share in ID verification and sort of like location services and fraud detection. So when it comes to sort of online transactions, they sell their software and their services to the likes of the banks, the sort of financial services, but also sort of like they do it to a whole series of others, e-commerce companies. They also did quite a bit during the pandemic to the crypto guys and to gaming, etc. So a whole dispersion of different sort of like, major clients. But to get into this market, you need a really good reputation. There's no way anybody's going to basically allow, somebody else to come into this market unless they've got a backlog of really good, or a sort of like, portfolio of really good blue chip customers who trust this business. And that's what they have. But the shares have come down from a high in the pandemic. I think they were over £9, and they're trading at roughly around about £2.30, £2.35 or something like that. And they did actually have some private equity interest back in September of last year at just over £5 a share. So they're in a really good, they've got the fundamentals of cyber security and sort of like stopping deep fake AI generated sort of like, cyber threats, etc. And the reason, and what you're seeing now this year, because of generative AI and how easy it is to create pictures and different content, etc., you're seeing an absolute explosion of deep fakes on the internet. And these guys should be perfectly positioned. Yes, they're going through a tough period as they sort of normalize coming off the pandemic, because the crypto demand they had, the boost during the pandemic, has fallen off. Gaming has obviously fallen off, and those were headwinds. But actually, they're still growing underlying like for like. And then last year it was about 3.7%. But there's no reason why in the medium term, these can't go 10% plus organic revenue growth. They're currently doing 21% EBIT margins. And there's and the management hoping to push that up as well. Very cash generative also. They've got a bit of debt, but that's coming down. So they should be really, really well played. And the valuation is that they're about 15 times PE, about 10 times EBITDA. But these are on really sort of like, modest financials. And I think over time, they're going to beat these, the estimates by, the brokers by a significant margin. If I'm right in terms of the tailwinds of all things cybersecurity and, these deep fakes. I mean, just to give you an indication, there was an article actually in the FT only yesterday talking about deep fakes on the internet, and they've so far.
Google, I'm sure Google are doing something as well. Now Google are actually attempting to get ahead of the curve as well and doing the same kind of thing. They're trying to set up a system or software system where they can figure out the difference between AI generated content and stuff and real human content. So it is obviously going to be a massive problem. That's one of the worries I had about AI when it first came out. So when we saw a while back, we saw fake Tom Cruise. Do you remember that Tom Cruise? And he was doing is that Tom Cruise saying some really odd things?
Like Justin Wade.
AI, yeah, and sometimes it's AI generated. How are you going to stop that? You know, it's nuts, isn't it?
So and they've been doing this for quite some time with machine learning and AI detection methods, and they do it through documents as well as obviously all the online software they have. And then you just say they've got brilliant to get the barriers to entry into this market are massive, because you've got to be able to have demonstrated you can protect people, and you can protect, it isn't just commercial organizations, it's also like the government, because they're giving out benefits. You know, the amount of benefit fraud is just enormous from potential. And they, and they're perfectly positioned for this. So yeah, I mean, I bought a decent position. What have I got? About 5%, I think. I'm just looking at it now. Yeah, just over about 5.1%. So I've got a full position. I'm delighted with it. I've now got 15 shares, and I think that one's going to do well. I mean, again,
when did you buy this? It's on a technical basis, but it's okay buying after it's technically been very bad, because it's going to rebound in some way. Because I mean, do you know?
I'm not bothered about technicals.
I mean, you just bought now. So
No, I've got my full position. I mean, the difference between me and you, I buy on the fundamentals, and I haven't got the skill that you have in terms of timing and technicals. I just say I just say I'm rubbish at that. I'm not. It isn't going to fundamentally change my decision about whether I want this, buy the share or not. And yes, if you look at it, the slope on the chart is awful, and it could go down. I mean, as I say, I've had many a stock where, in fact, most stocks I buy, I never buy at the low, and I never sell at the high. Simple, and never sell it. So you've just got to accept that.
Well, do you know what? This though, it actually you've just bought when it's been sort of massively oversold on the what's called relative strength index. It was down at 23, and it hasn't done that. It doesn't. Last time it was down this level was the big sell-off back in November 2022, and so. You haven't bought some, when it's been very weak, the share price, because it should be.
I'm not sure that gives me any comfort though, but
yeah, but when you want to see it rebounding to get above that, almost it keeps trying to get above a 50-day moving average, and it can't. Well, it comes back down, so it may do it though. That's the trouble. They are sort of in sync a little bit, aren't they? Because you get stocks that come down so far that their valuation becomes, compelling, and you think, well, that's so cheap. Regardless of the chart, sometimes it's so cheap, and people catch on after a while.
Well, I mean, I've got a fair value for that of £4.20, so I think there's 80% upside. I mean, just to fill in the blanks, I mean, I've got one for basically for Michelmersh we talked about earlier. I mean, mine's well over 150, so I think there's plenty of upside there. And anyway, the chart doesn't look great on either of them, and on Eleco either. But I'm prepared to hold, and I don't mind losing some more money in the short term, just as a paper, But I think for 3 to 5 year outlook. I mean, I've held Eleco since 2015, 2016. So
Eleco's seen the bottom there, though, isn't it? It seems like. I mean, it tells you how.
I don't know.
It's gone, from 64.
I wouldn't be betting on it, that's for sure.
64, 75. I think it's almost like a little bit like house builders. It's hit the bottom, rolled over, it's retesting that bottom again. I mean, Gleason's the same. It hasn't quite gone to that low in October back then, but it is round about that level. I thought, okay. There we are.
I mean, the other one I've bought just recently as well, since we last spoke, is Bristol Myers, which is obviously a massive, great, big biopharma, a bit like Pfizer. It's got a big franchise in oncology, really good one in oncology and cardiovascular, and a bit in immunology as well. It's trading at about 8 times PE. It doesn't need to make any transformational acquisitions, because it bought Celgene in 2019 and has got a good sort of pipeline of assets that should see growth. And the way I look at it is such that this business is growing its top line probably over the next decade at sort of 4 to 5%, which is similar to Apple. And it's going to grow its EPS probably a high single digit, double digits, which is probably slightly faster actually than Apple, but similar sort of like. And Bristol Myers trades on 8 times PE, and Apple trades on 30. And you look at it and you think, okay, there's a big defensive moat around Apple, but there's a pretty big defensive moat about, blockbuster drugs as well, sort of like, which have got FDA approval with huge patents and runways ahead on. So I just look at it and just think, what's happened a lot in the market as people have rushed into the AI play and into all things tech and certainly in the mega caps, etc. They've had to sell to basically get some money to put the cash into those, and things like Bristol Myers and Pfizer and Roche and those big healthcare companies, they've just been used as a source of funds, which has artificially pushed the price down. So like it's one of those classic go where others are selling, because the fundamentals haven't changed, even though the technicals are awful.
No, exactly. I mean, there's that saying, isn't it? Well, I think one of your guests said it, but it sticks out in my mind. You know, in the short term, it literally, you overestimate the power of like AI, and in fact the internet as well. Everything goes up crazy, like, you know, on with AI related. But in the long term, you underestimate it. Like I said, you know, go back to the internet, it transformed our lives. And at the time, there were lots of AIM companies just changing the name to .com, and they double overnight, and they had no sort of internet offering really whatsoever. But then longer term, they faded away and they crashed and burned, and the real winners started to come out, you know, and so started to do really well. But and that'll happen again, I suppose. But yeah, I think the heat has got to come out. Apple now, what, a $3 trillion company? It's phenomenal. I think the
Oh yeah, well, I think Microsoft is up there as well. How's your Good Energy getting on? Because didn't they come out with a trading update or some results?
Yeah, well, do you know, oddly, this morning I've been going through the entire RNSs from the last 2 years, and I was looking at
Did you sleep last night?
Because you know, I was going to do a little presentation of them, because I thought this is nuts now. They are literally at 180 shares. They just came up with a trading statement, and they've acquired another business. But let me just get the RNS. But it's a solar business. But they just announced that, I mean, some of this is restricted cash, but they say the cash collections have been very good. Everything's in line with trading. And they say right now they've got cash and restricted deposits at the end of May increased to 38 million. So hang on. The company's only valued at 30 million. They get 5 million in debt. But literally, they transformed, I think, back end of 2021, where they had sort of a generation site with wind farms, a lot of debt involved in that. They sort of sold it off. They got 24 million in cash from that. And now they're in just, they get sort of the power from there. They've got 270,000 customers. About 2,000 supply them with power. And also now they've gone into solar heat pumps, Zap Map, and all that stuff. And so literally their net asset value, I think, is about 38 million. And so, you know, it's 8 million right below where they are. They're profitable. And even the CEO last bought about £4 a share, and they're 180 a share. And I'm just thinking, there's something wrong. And I think the Ecotricity, who required a general meeting recently, or a while back, they tried to take them over by a hostile bid a while back. They own about 28% of the company. I think they may be selling a little bit. I haven't seen no TL1s because there's very little volume in there. But I just think they are growing. That they're going into a sort of an renewable energy services business, which is higher margin. As yet, with previously, you know, they were quite a low margin business. But and you can tell that. But they're doing, I think this year they're forecast to do 326 million top line in revenue. That'll dip next year because there's less of the low margin stuff. It'll dip to 302 million forecast, and then back up to 325, and the margins get better. Even on some ridiculous multiples, you know, on those margins, even at EBITDA of 4 and like, you know, a PE of 15, because they are growing. You're looking at more than double the share price here. I mean, I'm looking at 2025. Around about 540. I mean, broker targets are 475, and they're at 180. And I think they've got plenty of cash in a very, you know, hot area, very loyal customers. It's a big customer base that they can sell through quite easily. The cost of acquisition is the lowest in the industry, and they are top of which, you know, they are the original, you know, green energy supplier, and there's a lot of greenwashing goes on. This company is a bona fide company like that, and so it's very interesting. I think it's one of the.
Does it own its generation assets, the actual solar stuff?
No, they sold us off. Those are the ones that held debt, and they said we're going to reposition the business to being a supply business. You know, supplying sort of installing solar heat pumps, but also supplying. But a lot of their generation comes from their customers. They've got 1,800 people supplied to them, smallholders, and all that. But so they don't hold that. But now, because of that, it'll be a higher margin business, and that it will transform the business. I think on those revenues, like I said, the margins are, you know, wafer thin, pretty much. They are like, I think, post tax margin of just over 1%, but that'll grow. And like I said, on those, they've got a very loyal customer base of, you know, huge customer base of over 250,000 customers. They're very loyal. And they said they just sell products to them because they want more sort of renewable energy products. But yeah, I just think it's do a re-rate. It's one of these guys. You know,
you still own them. You still own them, do you? Yeah.
Yeah, I still own them. Yeah.
Which ones you own? You've got good energy. You got Destiny Pharma as well, haven't you?
Destiny Pharma. Yes. I also purchased. I'm really getting into the new energy bits. And I also purchased a little bit of Invinity energy systems.
Okay.
Now,
yeah.
I understand there's a
Palladium batteries.
Yeah, vanadium flow batteries. They are one of the world leaders. I mean, if you Google, and it's very rare. And when I'm looking for companies, and I call these hope high potential stocks, they could deliver multiples of your return, but they're very high risk because, I mean, if you look at the, I sort of wrote a little article on Vox yesterday about them, but if you look at the forecasted revenues, now, like I said, they're all forecasts, take with a pinch of salt, but they are massive. And the difference in lithium ion and vanadium is lithium ion are sort of, they're lighter weight, they're more power dense, but they are, there's a lot of competition from EVs as well for the storage. Lithium can become more expensive, but also there's a fire hazard with lithium ion. If you store a lot of them, they get very overheated very quickly, and there's been lots of fires around the world with them, and so there's been a worry in that sense. Now vanadium, even though it's not power dense, they hold the life of batteries by 25 years, whereas lithium you have to renew them in 5-10 years. So over the time frame, the sort of localized cost of storage is cheaper with vanadium. Now, what's interesting is Invinity are coming out with a new generation battery. It's in partnership with Siemens Gamesa, who owns wind turbines, of course. But the new generation of battery puts them way above anyone else as far as efficiency is concerned. And like I said, vanadium, you look at the very nature of renewables, if you want a sustainable source of battery storage, then having batteries that last for 25 years as opposed to 5 years makes a lot of sense. But you're not going to get them in cars and stuff. It's very, they've done a deal with UK government for long duration storage.
These basically grid scale, isn't it? It's major sort of like battery farm.
And they come in containers. Basically massive containers, and they can modulate and stack them. And so because of course the problem is it's fine having wind and solar, but like you say, where do you put that? When do you generate them? When the wind's blowing, you're not going to use all that electricity as it's created. So you need to store it somewhere. And these are one of the best options for storing. So you'll see all these wind farms or solar panels around the country.
I spoke to, and I don't know if you've probably, when I interviewed Paul Jordan of Amati, Paul Jordan of Amati about 3 weeks ago, he was really positive on it. He likes the science, so the usage.
Well, exactly. I mean, a lot of, if you imagine, these are very capital intensive, creating these batteries, but they're now sort of at an inflection point where they're going from making big losses next couple of years now. They probably need another fundraising maybe in a year's time. They said they've got cash flow, but that's when their commercialization of the new battery kicks in, and then they can really ramp up. And I think that they'll have a steer on most other companies who are burning a lot of cash, and they won't be. And if you look at their revenue top line, I mean the forecast, and that's 22 million. They did about 2.9 million this year for 22. 2023, almost 10 times that, 22 million. 2024, 30 million. Okay. And then 2025 is when they've commercialized this new, it's called Project Mistral, this new generation battery, because from 30 million to 134 million top line for 2025, and 2026, 215 million. And then they're generating around about 10 million pre-tax profit in 2025 and about, I think, 30 million in 2026 forecast, because then that's, of course, operational gearing kicks in and the sunk costs of kicking in. But yeah, but again, it's a longer term play, but I've only got a small position. But I think it's very, very rarely do you get a world leader on AIM, that genuine, because I think anything, it's probably get taken out at some point or that, because it's a huge area. You've got to store this energy, and that seems the best long-term option is vanadium flow batteries.
Yeah. I mean, another world leader on AIM that is going through that type of inflection point, the hockey stick, which came out with its 2022 results, is Belluscura, the portable oxygen concentrator developer. And what it said, it basically released inline 22 numbers and a positive sort of outlook. But it's going to see, it's really excited about this new device it's releasing. It'll be a fully commercialized launch in Q3 called their Discover, which is sort of like half the weight of the next best product on the market, but delivers 3 times the amount of by weight the amount of oxygen and they're already soft launched it, and there's a patient who's using it and loving it, and the feedback they've had from their distributors has been absolutely fabulous. They've got 125 in the US who are already signed up and have indicated they want volume, and some of the comments on their release were very, very positive for the new product, and that will really sort of be their vanguard, sort of their flagship project or product medical device into 2024. They're a first generation. The Explorer is still selling. It's still selling well, but they might also white label out that to to maybe distributors or to people who else want their own sort of portable oxygen concentrator. They've now gone through their funding, which they needed in the first half. So they raised a bit of convertible debt, and they raised some equity as well. So they've got the cash runway ahead. They shouldn't need any more in terms of, they should be self-funding. And it really starts kicking in 2025 and 2026. They should be, looking at the numbers, they should be at the back end of 2024. They should be cash flow positive. That will really kick in 2025. And we start seeing some significant volumes coming through, and they're indicating it's sort of like, 2,000 of the, sort of like devices per month. That will generate significant money for them. They've got manufacturing at their own site in the US, and they've got the one out in China kicking in, and they're seeking approvals out in Asia and in Europe. So it should do really well. Treats obviously COPD and other respiratory conditions that patients have. Lots obviously if you smoker, etc. Then it really helps, and these are things are very portable, and they give you what you want and allow you to get out of hospital. So it's best in class technology, but having best in class technology is still difficult to commercialize. If you think about the sort of the roadmap or what they've had to negotiate, they've gone through basically the clinical trials or the data to get FDA approval. Now they're going basically to get that whole supply chain sorted out, which they've now done, the distributors, which they've now done. They've got insurance cover as well. And really what the last bit of the piece of the jigsaw after sort of like, a few trials and tribulations is to really sort of start hard launching these. And it does seem the demand is very strong. So hopefully after a bit of sort of ups and downs for shareholders, we should see a really strong positive trajectory. And I'm hoping to be able to sort of touch base with the CEO, Bob Rorker, later today or tomorrow, and just get his latest thoughts, particularly on this new device.
Yeah. Well, the worry is sometimes when you're an investor, a private investor, and you see the potential of these best-in-class companies, the temptation is to go too big on them, because you see massive potential going forward, but you don't realize the market's going to be volatile and it's going to shake you a little bit if you've got too much of an exposure into it. And that's why I'm bad in this. I get really research company, get really carried away, really excited, enthusiastic about the potential, and I go too big, and all of a sudden a market shakeout. Like just then, when I said Invinity, I said they probably need to raise in about 12 months time, and I shouldn't worry about that, because they just raised 23 million in a bear market at very little discount. When you got companies like this that are best in class with a lot of demand, and I imagine in 12 months time the market will be a lot different, a lot more buoyant. Their cost of capital come down a bit, and there'll be a lot more sort of easy to issue equity. So I wouldn't worry about that. They're recently, so it's just, that's one of the things. New companies have to raise money. I know it's funny how private investors hate companies raising money. But if it's going to good ends, then they've got to. That's what AIM's for, essentially. As a raising capital. At the moment, it's very hard to do that, but in a year's time, it won't be. And if it's the company,
I think if you invest in those companies, even if they've got to raise money that have secular tailwinds, your likes of Invinity and your likes of Belluscura, then they're going to get access to capital. That's the key, because the growth opportunity is enormous. So I think that's a sort of like, if you are going to do it, then that's the way to play it. One which doesn't need to raise any more money. It's got plenty of it, but it came out with some good sort of like prelims or audited is CapeBox. And as you saw, what was when we chatted about it sort of like 3 months ago, they were starting to see that whole normalization of consumer buying habits after the cost of living crisis. Just as these are the sort of the UK's go-to provider of sort of like Celebration fresh cream cakes, and they've got their own shops, they're all franchise shops. they're capital light, sort of like gross margins of high 40s, you know, sort of like percent, good operating margins as well. They've got about 6 million of cash on their balance sheet. Anyway, what they've seen since the end of their financial year, which is in March, these last 4 months, they've seen that normalization and acclimatization of sort of like, you know, household budgets, getting used to the cost of living crisis. They've seen that come back even stronger. So they were down the first half of 2023 about 1%. They were then up 3% in the second half, and now they're up over 5% year to date so far on a like-for-like franchisee sale. So they are really sort of getting some momentum, and not surprisingly, the shares have responded well since the numbers.
Yeah.
But
well,
I mean,
I looked at them yesterday actually, and then to put this to the spreadsheet. I was surprised when I realized they're largely franchised. Their efficiencies, well, all green on their health there, and efficiency, like I said, 50% gross. Operating margin 16, net margin 12, and they think, hang on, I thought we were a retailer. And hang on, they're a franchise. That makes a lot of difference, isn't it?
Yeah, I mean, their cash flow yields over 11% as well. You get a nice chunky dividend, you know. So for income investors, and coming back to the fundamentals, it's quite interesting that 18 months ago, the CEO and founder, Sut Chamdal, he bought a shed load of shares at about, I think it was about 120, 130, that kind of level, you know, a couple of million, I think it was. And then he saw the shares decrease to a low of probably around about 70p at one stage. And I can't remember exactly what it was. And everybody was thinking, oh, that, you know, technicals, but now it's back and it's above. And so you look at it, you know, he saw that this was a temporary sell-off. He didn't know when the stock would ever bottom out, but he could see the upside, and I think it's coming forward. I mean, the house broker has got a, you know, target price of about £2.50, and I could see that easily being done, particularly if you look at their trajectory. I mean, they've still got plenty of sort of bandwidth and runway ahead for expansion in the UK into places like, you know, underserved areas, Scotland, Northern Ireland, Wales, and these kind of places. But frankly, at some point in time, they will go abroad, and once they allow the sort of like, you know, overseas people to taste the fresh cream, you know, sort of like, you know, cakes and stuff, it'll go down as well as it is in the UK. And they won't do it. They'll have their own stores. They'll have a franchise model there as well. So who knows? But it could do really well. I mean, I don't think there's much risk in it anyway, because it's got a rock solid balance sheet, good margins, and in a tough consumer market, like for likes, you know, in the store are actually going up. Yeah, which says everything.
Yeah, well, they got but net, cash about 6 million, isn't they? Net cash. Yeah, it's and generating cash. And in fact, a nice chart there, because they were literally banging their head on 130 level for quite a while, and then on the results, so they broke out now. They're at 140, so it's a nice break up there. Cool.
Another one on the another one in the sort of healthcare space is Oncimmune, and that's still going through its sort of like, you know, turnaround strategy. And the previous CEO, Adam Hill, has graciously decided to hand the reins over to this new guy, Ron Kirshner, who I haven't actually spoken to yet. He's going to become the interim CEO whilst they sort of like, you know, firm up who's going to be the final guy. There's basically what happened was such that because of the cost of capital on both sides of the Atlantic rose so fast, that put a huge brake on a lot of development for sort of like, you know, biotech activities, early stage, you know, research and stuff, because they had to decide which ones they were going to go for, and they stopped early stage largely and went for the, you know, the later stage products. And that sort of like, you know, had a demand air pocket for the Immuno Insights business. So they've struggled in the first half, and it will get better in the second. They're starting seeing some early green shoots, but it's still going to be tough sledging. And then the next year they should start seeing some, you know, some good improvement. Luckily, they've got they've got plenty of cash. They can get through it. It's not a problem, particularly after they sold their early CDT lung cancer test for 13 million. So that's not a problem. But the fundamentals haven't changed. The industry still needs their technology. They've just gone through a bit of a, you know, tough period. And as I say, I'm hoping to catch up with the new CEO, Ron, at some point in time.
Where's Ron from?
He's basically been working at at Oncimmune as their sort of lead legal guy, but doing a lot on the operational side over the last 3 or 4 years. So he's absolutely familiar with the actual business itself.
He sounds like he's Ron Kirshner. It sounds American, that name, doesn't it? Ron
Yeah,
Kirshner.
no, I don't. Yeah, I don't know. He does. I think he's English actually, but I don't know. Anyway,
so I talk about that area, so sort of med tech and all technology and biopharma and all that stuff. What's annoying is so Destiny Pharma came out with this news today. As you know, Neil Clark, the CEO, stepped down a while back. It wasn't expected. The share price took a knock, and in stepped Dr. Deborah Barker, who's a lot more experienced. She's led at infectives at high levels in big multinational companies. But they come out with a business update. That was very good. And they're very positive. And it's nice to see they've got a plan here. And they said they've also brought on a business development person who's going to go to America, but. And they said they're in discussions with many partners on their XF73. This is their second asset going into phase 3. They want to get a partner, of course, because phase 3 is quite expensive. They've done that with their first asset, which is M3. Now, XF73 has double the potential of M3, plus they own it outright. And so they're saying here, market potential size 2 billion for this. And they do say
2 billion. Wow.
The ongoing, so was it 7 more partners? So this is what I like. There's several of they're talking to people already on partnership with this. Several number of interested global parties have access to the XF73 data room. The company anticipates several more potential partners will be granted access in the coming months. They do say they're going to do a deal before the end of 2023, and they will do. I mean, this is a better team now than it was previously, and yet the share price dips by
the technicals.
and I go, yeah, it's technical. What's going on here? It's so annoying. But they do say that they are. Maybe some people at this point. Deborah Barker, they're looking at the CEO search is ongoing. This is also a priority for the board. Whether that will be Dr. Deborah Barker or not, I don't know. But they say the priorities on XF73, they'll get a deal there, and it just dips. And come on, what's going on here? They've got enough cash for H2 2024. A deal's going to be done before then. What's the way? This is like a 28 million market cap, and like I say, you got 3 separate brokers. Targets based on the first asset, not this, which is double the potential of like 800% up on this. So they were 270 a share. So it's nuts, and it's worth looking at those. If you doubt it, get access. I'll send you a broker note if you want. Have a read through it. It's hugely well researched. It's not just guesses. They're not picking numbers out of the air. So I just don't get this at all. Like I said, this was triple the price back when they had not 2 assets, not one deal on one, not when I had cash.
Yeah, well, that comes down to the debate between technicals and fundamentals, because the fundamentals look as though they're improving from what you've just said to me, but the technicals, what's happening is that, I mean, obviously small caps have relatively lower volumes, etc., going through them. And all you need is people deciding, I want to de-risk my portfolio, and this is in the higher risk, higher reward type opportunity, and they'll sell it, and that's what's happening. And you've just got to accept that the market is daft sometimes.
Yeah.
And I've and you exploit it. But I put a position in on a company straight away. If it goes down, then I typically don't double down, because if I'm wrong, then I'm going to get absolutely taken to the woodshed. But I'm happy then just to keep on holding and holding and holding. And if the fundamentals are still there, and you just got to accept that that's what happens in markets. Markets do what markets do. And if other people decide, despite the good fundamentals, I'm going to sell because I want to take some risk off the table in a sort of like a cautious backdrop, then that's what they do, and it's going to push the shares down.
Yeah, it is nuts. They do say, I mean, I look at the broker note here. They say it's compelling. They said it could be the new standard in post-surgical infections, and it's specifically has an unmatched resistance profile and fits well with existing hospital procedures. So they say, the commercial potential of this is massive. It's one of the things people are not getting the story yet. Maybe they'll get the story when it rises by 100%, and there's still more left. But I mean, it's almost like that, isn't it? People almost chase rises, but it's one of the things that you're not going to get this kind of. Once the bull market ends, or the bear market ends, and they have a deal on this, it'll be a lot higher than this now. Of course, you have to suffer a bit of turbulence in the meantime. But the biggest worry about these kind of companies, Do they have cash, first and foremost? Yes, they do. And they have cash till H2 2024. They're not going to need to raise. Once the deal is done on this, they'll have a cash upfront payment anyway, which will extend the cash runway beyond H2 2024. And they're confident getting a deal before the end of this year. So, it's just frustrating seeing this share price go. News comes out that I see as a positive, and then the share price goes down. I think it's so annoying.
Well, the same happened with Avacta. I mean, they came out with some news that they had basically their phase 1A trial for their AVA 6000, this chemo targeted cancer busting drug, or which it basically has now gone on to phase cohort 6 from cohort 5, because the safety data has just been so good, and they're doing that to get even a higher sort of maximum tolerated dose, which will hopefully, if it eventually comes to market, may even expand the sort of the patient population. And they've gone to, so there were already 2.2, I think, or 2, something like that, more than the existing doxorubicin, the standard drug, in terms of dosage level. And now they're going to over 2.5, or I think it's 2.7 in their sixth dose. So great news. Plus, they were starting to, the biopsy data which has come through has confirmed that doxorubicin is being released onto the hard tumor. And, they haven't yet been able to verify the efficacy, but you can guarantee doxorubicin, if you've been released onto the tumor, should be shrinking it or should be stopping the growth, because that's what it does. We've seen that there's decades of data that doxorubicin does that. So the efficacy should be there, but that hasn't yet been clinically confirmed, and we will start seeing some proper efficacy data in phase 1B. And then they came out with their presentation yesterday for their AGM, and they're indicating the sort of trial design for phase 1B once the phase 1A is actually completed, and they're doing sort of like up to 20 patients in 2 dosage levels with more cycles. Sort of the patients can be put on with more cycles, sort of like, I think it's doing 12 to 18 compared to, I think there's only currently with just standard doxorubicin, I think the maximum is about 5 or something like that sort of range. So this is significantly more and should help, the actual patients. And in fact, some of the patients are already in the trial are still on the drug because they're seeing benefits, and they're continuing. So the fundamentals continue to get better for Avacta, but the shares have done nothing. It's exactly it's that classic same sort of thing. You just got to, if you believe that the technology is going to work, don't worry about the day-to-day movements in the shares, even though it can get hugely frustrating for your portfolio.
No, it is frustrating. Like I said, with Destiny Pharma, they've gone through 2 phase 2s. So the data is more compelling. There's phenomenal data they've got there, and yet it's just frustrating. Like I say, things.
I mean, another one on the medical ones, which I've talked about before, which has came out with an AGM trading update, is Inspiration Healthcare, which does these sort of like a premature baby ICU sort of warmer units and heating, etc., and the ventilation units and all the consumables. And it's on track. It sees an improving trajectory. So it was cash flow positive in Q1. Had seen increasing gross margins that had continued into Q2. Higher revenues in Q2 than Q1. So that's great. They are going to be second half weighted because as the economy still sort of opens up, etc. But they seem to be generating positive cash. Gross margins are increasing. And they're doing what they've said they're going to do. And if they, in my view, if they hit those year-end targets and give themselves a good launch pad into 2025, I mean, my valuation is about 85p. They're currently trading about 55, and I could see them going a lot higher than that as well in the fullness of time, because it's a good sort of IPR-rich type, business. The CEO there is Neil Campbell.
Neil. By the way, I also just mentioned we didn't mention Trufin before. They raised some money, and the reason for that, they raised some money because, as you know, there's 4 parts to Trufin. Stargo and place that sort of exciting, sexy upside areas, and then you got the sensible auction inverters. But the reason why they issued shares to raise money was to buy the franchises of Morton Shell. Morton Shell was the big game from a company called Coal Symmetry. Now it did 1 million units from a standing start. It's like when you release, the gaming area is very competitive. A lot of games be released, and what you want is a big hit, a blockbuster, because then you can start a franchise, because then you've got a fan base already chomping at the bit for number 2. And so they raised some money for this, and they've literally got the rights to Mortal Shell 2. And like I said, they got Mortal Shell 1 generated 15 million. Now, remember, Mortal Shell didn't exist before Mortal Shell 1, and it sold 1 million units. And that was sold, I think it was 8 to 10 hours of gaming time in that, 1 million units, and it retailed at about, I think it was $29 pretty much. Now, Mortal Shell 2 will have 30 hours of game time, and it's going to be retailing between 40 and $50. And so you can see this, it'll probably do 1 million units, probably more than that, because you've got that base already there and more. So they did that, secure that that franchise there, which is very good. And then if that does well, Mortal Shell 3 comes out. That's what you want, is that kind of, that hit under your belt, and that will help them elsewhere. So that's very good there. But they did a
do you still own Trufin?
Yeah. So I mean,
so you've got Good Energy, Destiny Pharma, you've got a bit of Infinity and Trufin. Do you know anything else at all at the moment?
Yes. Well, I own Alphawave Semi. I mentioned that.
Of course, yeah.
I did some more research on those. Phenomenal IP they've got. I didn't realize In Silico is another company in this area. I know you've got Sondrel, but they supply the IP for In Silico pretty much. In fact, they're one of the biggest IP libraries for chips and chiplets in the world.
Yeah.
And so that's why they've got special sort of relationship with the chip foundries, like Samsung and Taiwan chip foundry.
You've done well out of that so far, haven't you?
Yes, it's good. I mean, I watched, like I said, I watched 2.5-hour video the other day on them. There's a presentation, and they're very impressive board, a very impressive board. And like, if you look at their compound annual growth, they could expect to be doing $500 million in 2025 of sales, and this is 187% compound annual growth, and they've got huge. They're up there with, in fact, the big. There's 2 others they're sort of competing with, but Marvel is one that chips, but the founder of Marvel left, and now he's a major shareholder of Alphawave. And he says these guys are doing things that no one else has done. Hyperscaler is one of their customers, but they're very impressive. In fact, you probably see a lot of it. In fact, Sondra, I don't know, maybe not, but because they supply IP to most of the smaller chip companies, because they
probably do, yeah.
IP, yes, they got phenomenal. But I was reading about chips. And it's a rabbit hole. It's so complex, isn't it? About not only designing them, the IP, the foundries, fabless, and fab, and the evolution. But but literally, I come out the back of it. I'm quite pleased. I hold the shares of this company. They could be one of the market leaders, And
that's the thing is finding some good tailwinds that you're prepared to hold through thick and thin. That's the key. I mean, it's like Sondrel with me in terms of,
that shot up after you mentioned them.
Yeah,
well, come back a little bit, haven't they?
Yeah, I mean, to be honest, it's quite a liquid stock, and they're going to go up and down. But I'm not that. As I say, I'm really not bothered about sort of like short-term share price. I'm more interested in how the company does longer term and whether it can actually, generate that growth from the tailwinds. But as I say, that's the sort of key, is looking for those secular sort of boosts that you can get. So you've got Alphawave. What other such? You got Trufin as well. What any others at all? Or are you?
Good energy. I hold a bit of Polarean.
Right, you're back into Polarean. Nice one.
I bought a bit of those after they did it with only a little bit. Like I say, I like the tech for a long time. There's obviously the CEO has changed there, but
Paul Scott of Scotopedia has gone into that as well.
Yeah. So I'm waiting for that. I've still got XP Factory. I'm talking about franchises. We're talking about Cakebox, all that. They are. I mean, at the moment, of course, a lot of work in the UK, but they are open to franchise. They've got franchises around the world anyway with escape rooms. But I think America could be a massive market for Boom Battle Bar. And they are looking at that, and they are looking at American. In fact, they've got, I think 2 in Houston for escape rooms, but they will be looking at that. They've got their hands full at the moment with UK because they've opened so quickly. But I think that could be a huge market for them. And once they've proven the model out, could do very well. Trufin. I'm looking at a couple of others, but I'm not really. In fact. I'm always looking, and at the moment it's having discipline because I've got cash. But I think, listen, the market could go further. And I've been watching certain stocks, but I think, okay, I really like that, but it's not, it hasn't come down in value a lot. And you see a lot of that good quality companies don't come down in value. But as I've waited, they have slowly. The market's bringing them down. I thought, okay, let
So
them
how
come
much
to me
cash
a
do you
little
hold
bit.
then? You got about what,
Well,
50% still?
41% is cash. Yeah,
Is what 50?
41%.
How much is it? Sorry.
41% of
Oh,
cash.
40. Okay, so it's
Yeah,
down because you were 60%, weren't you?
yeah. I do hold, like my biggest holding now is pretty much it's IUKD, which is a dividend paying fund. It's FTSE
Yeah, okay.
350 fund. So just because I think I just want to sit there in cash, I want to get some money back as well. But that's even takes a bloody knock. It's like, you know, you think it'd be stable on a dividend paying fund. It's like, but that's even gone down by 5-6%. But
that's what happens in markets. They go up, they go down. So you just got to accept it. I mean,
so that's largely because it's FTSE 250, because they've got 50 stocks, highest paying yielding companies, FTSE 250, 350. But the FTSE 250 companies are taking a bit of a hit. I think.
Yeah, I mean,
that went down.
It comes back to the house builders you were talking about. Anything in that sort of like UK focus has been absolutely welled, and they look good value. I mean, my cash position's now only 12%, which I had about 45% at the start of the year, and I've been whittling it away with a whole bunch of different purchases. I mean, if I look at it overall, I've bought GB Group, Pfizer, Bristol Myers, Roche, Michelmersh, Inspiration Healthcare, and Sondra, and TP. So I've probably bought about 8 stocks this year so far. Yeah.
You still hold? There's two you mentioned. Was it Active Ops and Census? Do you still hold those?
Yeah, no, I still own them. Yeah, absolutely. Okay. I mean, I'm very positive on Active Ops, but as I've always said, you know, it's work in progress for Census. They've got good technology. They were profitable before they listed back in 2019. They went through this massive expansion strategy across the States and to Asia. They've burnt through a lot of cash. And currently, it's a race to profitability. If they can get this business back up into cash flow positive before they run out, then it will double, triple. It'll do really well. But given it's a tough market in commercial real estate at the moment, they've got their hands full. And that's the reason why. And it's dropping down on no volume, but I wouldn't. Would I if I hadn't got any shares? Would I buy now? It depends on my risk tolerance and sort of like I certainly wouldn't be selling. That's for sure. But my instinct is saying there's far more upside than there is downside. But if I was going to say what is the most riskiest stock in my portfolio of 15, it's that one.
Okay. Have you been keeping an eye on the Revolution Beauty and Boohoo soap opera?
It's great,
phenomenal. The story. It's like going back and forth. I mean, I don't know if anyone knows the story, but I sort of highlighted it recently. I mean, it IPO'd REVB, didn't it? A lot of promise, and then they appointed a new CFO. Then there was a change to the results dates, and then an audit. Then Boohoo took a stake, I think, in August last year. Then they kept updating the publication of results. Then they're suspended. And then Adam Minto resigned as CEO and founder. I think Bob Holt was brought in as CEO. And then Boohoo sent requisitioned AGM and wants to throw out Bob Holt and the CFO and all that stuff. And it turns out they did throw him out pretty much. Then the remaining director of REVB appointed 2 directors who reappointed Bob Holt thing. And then now, so they got that. And Bob Holt today bought some more shares. 3 of them bought much more shares. And then Boohoo saying, hang on, you've also given yourselves free shares. Where's that come from? That wasn't in any of the published documents. What's going on here? So it's like a soap opera. Who's going to end up winning in this? I think, well, Boohoo's got.
Well, I mean, we don't know, but I would say the key bit is that Bob Holt and Elizabeth Lake, the CFO, the business is now back on track. They've sort of right sized, so we should say that they've made sure that the ship is sailing in the right direction, and they're starting to see some very strong like-for-like growth. They're back into sort of like profitability, and it looks as though they're cash flow generative as well. It's certainly on a trading basis. They've done a great job, no doubt about it. Now the big question is who should own this? Should it be a public trading company, or should it be owned by Boohoo? And I think the existing directors, their biggest bugbear with what's happening with Boohoo is such that they think that Boohoo's trying to buy it on the cheap without paying a control premium. Let's just wait and see. I mean, I think there'll be lots of synergies if Boohoo bought Revolution Beauty, no doubt about it, and therefore it comes down to price. But Revolution Beauty, if you just look at it, I mean, we don't know. It'd be interesting to see what the latest sort of like half-year numbers are going to be. But it looks as though there's good positive trading. All I would say is if you're a shareholder, I don't think there's much downside. Either way, you're going to get a positive result. It's either the management team's going to win, and the share they're going to continue with the trading, or alternatively, Boohoo will buy them and will sort of like integrate it. I would say if you're a long-term investor, probably you want to be in the former camp. And if you're a short-term and just want a quick turn, then, Boohoo will probably put a number on them at some point in time. I mean, that's total speculation. I've got no idea whatsoever, but I would be, I'm actually delighted the business is now turning a corner and it's moving in the right direction, which is the key for value generation of that business, whoever owns it.
Yeah, yeah. Well, I'm just, it's like an unfolding soap opera. I'm just interested in it. But yeah, the shares have jumped up a little bit since they came back to market. Well, they came back to market, they jumped up at 27 pence. They were 20
no, I mean,
so,
on their when they were relisted, unsuspended, and they came out with that statement, I was tempted to buy some right on the open, and then they doubled or whatever it was on the open. I was thinking, okay, right, let's let this thing settle down first.
Yeah, yeah. Just one further thing. Just again, this is waiting. One of the companies I was looking at was on the market, right? And because it's in the house building area and all, well, a house building in that area, and I just had an alert say a new low. Now they're 40 million market cap. They've got like 10 million cash. They're doing 34 million of revenue pretty much. I think, well, how low can that go? In fact, didn't one of the guys who spoke to recently?
Yeah, Christopher Mills.
Christopher Mills took a bigger stake in them. Yeah, so and he was saying he doesn't understand it. What's going on about it? You don't get these kind of things for this price. So yeah, so that's very interesting. But it just at the moment you just sit there and watch these prices just go lower and lower. And you think it's going to be a massive bounce sooner or later because some of these stocks now compelling value.
Yeah, and if somebody buys them or bids for them, you could easily see a 100% premium on day one. I mean, it would not be surprising. It'd still be a bargain for the acquirer. I mean, yeah. So it comes down. I think I'm short-term cautious on the market, and we've talked about that before. Not on the market, the company, but actually on the economy. But I'm actually positive on lots of small caps and micro and mid caps, simply because the price has come down so much that it's discounted like 2 or 3 or 4 recessions on top. And as long as you chose companies that can get through it, then you'll do well in 3 to 5 years. But keep your hat on, keep your tin hat on, because it won't be easy sailing, I'm sure.
No, yeah. I mean, if you're buying something now, always expect a future sell-off to happen in some point. So we do see these little waves within waves of sell-offs, and then a couple of about 2-3 months of rallies, and then sell-off again. But this is finding the bottom here. But
I would say what a good indicator or anecdotal indicator, and on a technical basis, that is, I would look at is just look at the banking sector, the shares in the banking sector, because they're so important in the economy. And they're bleeding. I mean, they've all gone down. So short term, be cautious, but long term, I think you can be positive, which is what I am to a certain extent.
Oh, Lloyd's. I did put, we talked about it a while back. So I just put an alert on it, 40 pence.
Yeah, well, there you go.
42 pence. And
there you go.
There.
There you go. I mean, that says everything. Rock solid type of bank with the shares selling off. I mean, just shows you the negativity associated with the economy, essentially. You're not going to get too many buyers. And the other thing, obviously, we've seen a lot of is in the small cap sector is fund manager redemptions. I mean, they're all having to sell stuff, and that's just like part and parcel of it. If a fund manager is to sell, they've got to sell. That's it. They don't want to. They'd prefer to hold, but they're forced into it because they need some cash. Yeah.
And so if you've got a little bit of cash yourself, it's a good time, really.
I know.
Which I have. But
having
said that, I did have a lot more in my portfolio about 18 months ago. So so it swings and roundabouts, I suppose. It was valued a lot more than it was now. But there we are. Marvelous stuff. Cheers for that, Paul.
Thanks, Justin.